Markets are locked in a standoff as the countdown to Friday's PCE report begins. The tension is high as investors navigate a mix of technical tripwires and inflation crosswinds, following hawkish signals in the Fed's latest minutes. We're also tracking a $120 billion credit warning that's adding to the precariousness of this macro setup. As we move through today's data, we'll see why the margin for error is thinning. The S&P 500 is currently testing the 6,800 level. Macro Voices notes that this is a critical threshold and a potential tripwire for systematic selling. Meanwhile, the US dollar index is stuck between 97 and 98. It is a clear state of consolidation, and the market is waiting for a breakout to signal its next direction. Turning to retail, Walmart's latest report provided a notable reality check. The company beat current estimates, but management issued cautious guidance for the year ahead, resetting expectations for consumer demand. It is a situation where strong results today are being met with clear caution about what comes next. Market positioning ahead of the PCE report is showing signs of heavy crowding. Nana notes that SPY options are currently pricing in an implied move of 1.39% in either direction, with a particularly high concentration in 680 puts. This setup could accelerate a sell-off if technical support breaks, though the extreme put-to-call ratio also creates the potential for a short squeeze if the data isn't as bad as feared. Meanwhile, Danielle DiMartino Booth warns that core PCE might surprise to the upside due to rising portfolio management fees, a factor that could complicate the Fed's policy path. There's also a technical gotcha in the inflation data that could catch the market off guard. Danielle DiMartino Booth warns that core PCE might come in hotter than expected because of how portfolio management fees are calculated. Since these fees are tied to earlier PPI data, those higher costs are now flowing into the PCE result. It's a lag effect that could complicate the Fed's path forward if the final print surprises to the upside. We're starting to see some real pressure in the credit markets. Blue Owl Capital has restricted redemptions on its direct lending fund, which signals mounting liquidity stress. On top of that, UBS is now forecasting up to $120 billion in defaults for software and data service firms over the next year, citing the disruptive impact of AI as a major factor. While AI disruption creates uncertainty across the tech sector, Moody CEO argues that proprietary data remains a formidable moat. The perspective here is that institutional clients still value specialized, trusted providers over generic AI tools. In an environment where UBS analysts are already forecasting up to $120 billion in defaults for software and data firms, this proprietary data layer is being framed as the critical divider between the industry's winners and losers. Recent 13F filings show a clear split in how the biggest names are playing big tech. Joseph Carlson highlights that while Bill Ackman's Pershing Square added a massive stake in Meta, Warren Buffett was selling down Berkshire's positions in Apple and Amazon. This rotation coincides with a widening valuation gap between retail leaders. Walmart now trades at 43 times forward earnings, while Amazon sits at 26.5. Investors are now weighing whether this defensive premium on traditional retail has become overextended. The valuation gap between these two retail giants has become quite extreme. Joseph Carlson points out that Walmart is currently trading at 43 times forward earnings, while Amazon is at just 26.5. This pricing highlights a major rotation toward defensive safety. Even though Amazon's revenue growth continues to outpace its brick-and-mortar rival, it leaves investors wondering if the premium on traditional retail has finally become overextended. The labor market remains resilient. Weekly jobless claims fell to 206,000, giving the Fed room to maintain its hawkish stance. On the geopolitical front, oil has hit 6-month highs as tensions between the US and Iran escalate. Bella notes this creates a binary risk for energy markets heading into the weekend. To hedge against this, Macro Voices recommends a defensive currency trade, specifically shorting the euro. Despite the murky macro outlook, Nana highlights that international capital is still flowing into U.S. equities, providing a liquidity floor for the market. One last major takeaway is the persistent flow of international capital into U.S. stocks. Even with the current macro gloom, this betting on America theme is providing a steady liquidity floor. On the watch list, keep an eye on the defensive setup from Macro Voices, specifically a short euro position hedged with call spreads. These flows provide a key backdrop of support as the market prepares for the PCE data and NVIDIA's earnings results next week. Heading into next week, our watch list focuses on three primary triggers. First is the PCE report, where we're looking to see if core inflation results in that 1.39% implied move in the S&P 500. We're also watching for structural risks in private credit, specifically any additional redemption gates that could signal broader liquidity stress. Finally, semiconductor sentiment remains a critical swing factor, with NVIDIA's earnings next week likely defining the near-term path for equity risk. The market enters the weekend caught in a standoff between a hawkish Fed and labor reality. Danielle DiMartino Booth notes that while policy remains tight for now, a potential shift in Fed leadership could eventually force aggressive catch-up cuts to align with employment trends. The immediate path remains uncertain. Check the description for all of today's sources and subscribe for your daily high signal recap.